Welcome back to the Deep Dive. Today we're diving into a real classic, The Little Book of Common Sense Investing by John C. Bogle.
It's a classic for a reason.
It is timeless advice.
So we're going to try to unpack, why is this book considered like the Bible for personal investing?
Yeah.
And hopefully we can do it without, getting too bogged down in the weeds, the jargon and all that stuff.
Yeah, we're going to try to make this really practical advice that you can use right away, whether you're a beginner or a seasoned investor.
Right. So, if you're listening along with us, I want you to think about how often you're making investment decisions based on emotion.
Hmm.
Did you buy that stock because it was a hot tip from, your uncle or,
Right.
Or did you sell something because you just got scared when the market dipped?
Oh, yeah. Fear and greed are powerful forces.
Yeah.
And Bogle really gets into the psychology of investing. And I think that's one of the reasons why this book is so popular.
Totally.
Because he understands that side of it.
Yeah.
He starts off the book with this great story, this parable about the Gottschalks family.
Okay.
And they inherit all of the shares of American business.
Wow.
So they basically own the entire stock market.
They own the entire stock market.
Which is, a great place to start.
Yeah.
And of course, their wealth grows as companies profit and pay dividends.
Right.
But then some family members get this idea that they can do better.
Oh, here we go.
We can outsmart the market.
Yeah, this sounds familiar.
Right. They start trading, hiring brokers who charge commissions.
Of course.
They bring in, expert money managers who promise even bigger returns.
Right.
But they also charge fees and they trade even more frequently.
So more costs involved.
Exactly. And what's fascinating about this story is that the more the Gottschalks family tries to beat the market,
Uh-oh.
the more their wealth actually shrinks.
Wow. So they're working against themselves.
They're shooting themselves in the foot.
And I think this parable is so relatable because we've all been tempted by that, that allure of beating the market.
Of course, we all want to think we can outsmart everyone else.
Right.
Yeah.
And Bogle really drives home the point that, in the long run, it's the costs that really matter.
The costs.
Yeah. He makes a clear distinction between what he calls investment return,
Okay.
which comes from dividends and earnings growth, and then speculative return,
Okay.
which is based on, trying to predict market fluctuations.
Right. So one is like the, kind of the more sure thing, and the other is trying to time the market, basically.
Exactly. And that's a crucial distinction because Bogle's whole philosophy is built on the idea that trying to outsmart the market is a losing game.
Wow.
He says, instead of playing their game, we should focus on capturing the market's return in a low-cost, efficient way.
So this is where the idea of index funds comes in, right?
Exactly.
This is kind of his, his big thing.
Bread and butter. Yeah,
Yeah.
he's a huge advocate for index funds, especially those tracking the S&P 500.
Right.
Think of it as buying a slice of the entire stock market,
Okay.
the 500 largest U.S. companies.
Right.
And the beauty of this approach is that you're not trying to pick individual winners or time the market.
Yeah. You're just kind of riding the wave of the whole market.
Exactly.
You're going with the flow.
So for, anybody listening who's like, okay, I'm not exactly sure how indexing works.
Yeah.
Can you break down this concept of market cap weighting?
Sure. So in a market cap weighted index fund,
Uh-huh.
the weighting of each company is determined by its market capitalization,
Right.
which is simply the total value of all of its outstanding shares.
Uh-huh.
So the larger the company,
Yeah.
the bigger its slice of the pie in the index.
That makes sense.
And what's cool about this is that it creates a self-balancing system.
Self-balancing.
As companies grow and become more valuable, their weighting in the index naturally increases.
Okay.
And conversely, if a company's value declines, its weighting decreases.
So it kind of takes care of itself. It does. It happens automatically without the need for an active manager to constantly buy and sell.
So less fees.
Exactly. Which keeps transaction costs extremely low.
I like it.
And those low costs can make a huge difference in the long run.
This reminds me of that story that Bogle tells about the lawyer who invested, what was it, $15,000 in the first index fund?
Yeah, back in 1976.
Like in 76, and just rode the market.
And by 2016, that investment had grown to over $900,000.
Wow.
Just by riding the market in a low-cost index fund.
That's amazing.
It's a perfect example of the magic of compounding returns.
But, as Bogle says, compounding works both ways.
It's a double-edged sword.
Yeah, he calls it the tyranny of compounding costs.
Right.
And, it's so easy to overlook those small fees, but they can really eat into your gains over time.
They really add up.
So you got to watch out.
He illustrates this point vividly in Exhibit 4.1,
Okay.
which compares the growth of a $10,000 investment with compounding returns versus one burdened with compounding costs.
Right.
And the difference is dramatic.
Wow.
It's a stark reminder of why keeping costs low is absolutely crucial for long-term investment success.
So, I mean, we've laid out like why indexing is such a, powerful concept.
Yeah.
But yeah, some people listening are probably thinking like, okay, sure, but some active managers could beat the market, right?
Mhm.
Like, what does Bogle say about that?
He addresses it head-on with hard data.
Okay.
He presents Exhibit 3.3,
Huh.
which tracks the percentage of actively managed mutual funds that outperformed comparable S&P indexes over a 15-year period.
Go 15 years. So, it's not just a blip.
Yeah, long-term performance.
Right. And so,
And the results are pretty eye-opening.
okay, lay it on me.
Across various categories, the vast majority of actively managed funds consistently lagged behind the index.
Really? So, like, most of them are not beating the market.
Most of them are not beating the market.
Oh, yeah.
And that raises an important question. If most professionals can't beat the market, what are the chances that you or I can do it consistently?
It's like you're saying, don't try to be smarter than the market.
Yeah. Right. Like you're probably not.
It's a humbling thought.
Yeah.
For anyone who's tempted to chase those hot stock tips or try to time the market perfectly.
Right.
But let's say, for argument's sake, that an active fund could outperform the market.
Okay.
Bogle argues that there's another major obstacle for investors to overcome.
Okay. What's that?
Our own behavior,
Oh, right.
our emotions.
That gets us every time.
Even if a fund manager could consistently pick winners,
Yeah.
Bogle points out that most investors sabotage their own returns through poor timing and chasing past performance.
Yeah, we get greedy. We get scared.
Exactly. He calls these the timing penalty
Okay.
and the selection penalty.
Timing and selection.
The timing penalty refers to our tendency to buy high when we're feeling optimistic
Right.
and sell low when fear takes over.
Like when everybody's freaking out.
Yeah, it's like we're wired to do the exact opposite of what we should be doing.
It's true. We panic.
And then the selection penalty comes into play when we chase past performance,
Piling into funds that have already had their moment in the sun.
because it seems like that's going to keep going up for
Right. We're always looking in the rearview mirror.
Yeah.
Instead of focusing on the road ahead.
Okay.
And he provides compelling evidence of these penalties in Exhibit 7.2,
7.2.
which shows how investor money tends to flow into funds at the worst possible times.
Oh, no.
It's a clear indication that our emotions often get in the way of making sound investment decisions.
So basically, it's like our emotions are our own worst enemy.
Oftentimes. Yeah.
So if we can't, trust our gut or try to time the market, like how should we be thinking about, building a portfolio?
Well, Bogle argues that instead of getting swept up in this frenzy of trying to beat the market, we should focus on what he calls the relentless rules of humble arithmetic.
Humble arithmetic.
I like it.
It's not glamorous,
No,
but it works.
it's about keeping it simple.
Keeping costs low, diversifying, and letting the power of compounding work its magic over time.
Compounding, that's the key.
That's the key. And a big part of that equation, I think, is understanding the role of dividends.
Absolutely.
He dedicates a whole chapter to this,
Yeah.
showing how dividends are often overlooked.
Yeah, they're kind of the unloved stepchild of investing.
Yeah, people are always looking for that quick growth.
Right. They want the excitement.
Yeah,
But dividends are a crucial part of long-term returns.
they are.
In Exhibit 6.1, he breaks down the historical total return of the S&P 500
Okay.
and shows how a significant portion comes from dividends, even more so than price appreciation.
Wow.
It's a reminder that dividends aren't just some boring extra.
Right.
They're a vital source of income and growth.
And they're more reliable in a way
Exactly.
than, hoping that the, price is always going to go up.
Yeah, you can't always count on that.
Right.
But dividends tend to be more stable,
They do.
especially when you're looking at those solid blue chip companies.
And, we often get caught up in the excitement of like the high growth, non-dividend paying stock. Yeah. But as Bogle points out,
Yeah.
those can be incredibly risky when market sentiment shifts.
It's like building your investment strategy on shaky ground.
Right.
Dividends, on the other hand, offer a much more solid foundation.
I like it.
And what's fascinating is how resilient dividends have been over time.
Okay.
Exhibit 6.2 shows their remarkable consistency over the past 90 years,
Wow, 90 years.
even during major market downturns.
So, through thick and thin, basically.
Yeah, exactly.
those companies are still paying out.
They're still sharing those profits with their investors.
It makes me want to go and look for some dividend-paying stocks.
It's a compelling argument
It is.
for focusing on companies that not only grow their earnings, but also share those profits with their investors through consistent dividends.
Right. So it's not just about, the hype. It's about the real value.
Yeah, the substance.
Yeah.
Now, before we move on, I want to touch on another crucial concept that Bogle introduces,
Go ahead.
reversion to the mean.
Reversion to the mean.
Have you ever wondered if a fund's recent hot streak is a sign of true skill, or if they might be due for a downturn?
Oh, yeah. I've definitely wondered that.
Like, how do you know if you're chasing a fleeting trend or betting on a consistent winner?
Yeah, because it's too good to be true.
Right.
Okay.
Well, Bogle uses this concept of reversion to the mean to address this very question.
Okay.
It's the idea that extreme performance, whether good or bad, tends to eventually move back towards the average.
Okay. So it's like what goes up must come down.
Yeah, in a sense.
Okay.
He shows this very clearly in Exhibits 11.1 and 11.2,
Huh?
which track the performance of top-performing funds over different periods.
So these are like the all-stars.
Yeah, the rock stars. And what emerges is a pattern of highs and lows,
Oh.
highlighting how difficult it is to sustain exceptional performance over the long term.
So you're saying even the best of the best.
Even the best of the best,
Yeah.
they have their ups and downs.
Right.
And it's hard to stay on top forever.
Okay, so if a fund has been killing it lately, it might just be a temporary thing.
It might be riding a wave that's about to crest.
Okay, so don't get too excited.
Don't get too carried away.
Right.
It's a crucial reminder that past performance doesn't guarantee future results.
I think this is a great place to pause.
Yeah,
We've covered a lot of ground,
we have.
but there's so much more to unpack.
Lots more to come.
We'll be back in a flash to continue our deep dive into John Bogle's wisdom.
Looking forward to it. You know, it's so easy to get caught up in those short-term market swings, but Bogle really brings us back down to earth with this emphasis on the long game.
Totally. And speaking of investments that often get overlooked, in the pursuit of those flashy returns, let's talk about bonds.
Bonds, the steady eddy of the investment world.
Yeah, Bogle dedicates a whole chapter to bond funds and how those same principles of low cost and indexing apply there as well.
It's easy to forget about bonds when the stock market's making headlines,
Yeah.
but they play a vital role in a balanced portfolio.
Absolutely, especially, as we start thinking about retirement and, things like that.
Yeah, bonds are generally considered less risky than stocks.
Right.
They provide a source of stability and income.
Yeah.
But even in the bond world, Bogle argues that active management often falls short.
Really?
He cites the SBV report, again this time focusing on bond funds.
Uh-huh.
And guess what? The results are strikingly similar to what we saw with stock funds.
So most actively managed bond funds are not beating their benchmarks.
You got it. Exhibit 14.1 really drives this point home.
Okay.
It breaks down the performance of various bond fund categories over a 15-year period.
Wow.
And the evidence is clear. Indexing wins again.
So even with bonds, Bogle's advice is keep it simple, stick with low-cost index funds.
That's the core message. He's a big proponent of total bond market index funds,
Okay.
which give you broad exposure to a diversified portfolio of bonds at a very low cost.
So you're basically capturing the whole bond market.
The whole enchilada.
I like it. All right, so I know a lot of listeners are probably wondering about ETFs.
ETFs, exchange-traded funds.
Yeah, they've kind of exploded in popularity in recent years.
For good reason, they offer a lot of the same benefits as traditional index funds,
All right.
but with added flexibility.
Right, and they're, easy to trade and all that.
Exactly. So what's Bogle's take on ETFs?
Yeah, I'm curious.
He doesn't dismiss them entirely. He acknowledges that they can be a very useful tool for investors, especially those who appreciate their flexibility and tax efficiency.
Right.
But there's a catch.
What's the catch?
And it goes back to that crucial element we discussed earlier, investor behavior.
Our emotions get in the way again.
Exactly. Bogle's concern with ETFs is that they're often used for short-term trading.
Oh, so people are trying to time the market with ETFs.
Yeah, investors get tempted to jump in and out of the market,
Oh,
trying to time those swings and capture quick profits.
but that goes against the whole Bogle philosophy.
It goes against the buy and hold long-term investing approach.
And as we've seen, trying to time the market is notoriously difficult,
Even for professionals.
even for the pros.
It's a fool's errand.
Okay.
He even cites a study that looked at the performance of the 20 best performing ETFs over a certain period.
Okay, the top 20.
And what's fascinating is that for 19 out of those 20 ETFs, the actual returns earned by investors were lower than the returns reported by the ETFs themselves.
Wait, how is that possible?
It's because investors were buying high and selling low.
Oh, they got caught up in the hype.
They got swept up in the emotions, they incurred transaction costs, and they missed out on those long-term gains they could have had if they had simply held on to those ETFs.
So it's like even with a good ETF, if you don't have the right mindset,
Exactly.
you're not going to benefit.
Your behavior can undermine even the best investment strategies.
So discipline is key.
Discipline and patience.
Okay.
Those are just as important as choosing the right investment.
All right, so I want to talk about smart beta ETFs.
Yeah, smart beta, the new kid on the block.
Yeah, they're kind of like the cool ETFs. Yeah, they're trying to be.
They're trying to be smarter than the market.
Yeah.
They're using alternative indexing strategies.
Yep.
Instead of simply weighting companies by size, they might focus on factors like dividends value or momentum.
So they're trying to like pick winners, basically.
In a way, yeah, they're trying to outsmart those traditional market cap weighted index funds.
Okay, and what does Bogle think about that?
Well, he's skeptical. He sees these smart beta strategies as just another example of the financial industry trying to convince investors that they can beat the market.
Right.
He even calls them closet index funds,
Closet index stuff.
suggesting that their holdings aren't actually that different from traditional index funds.
Oh, so it's like a marketing ploy.
In a sense, yeah. And as we've seen, the data really supports his skepticism.
Really?
He presents Exhibit 16.1,
Okay.
which tracks the long-term performance of some early smart beta ETFs.
Okay, so they've been around long enough to have some data.
And what's striking is that over a 10-year period, their performance was very similar to that of the plain vanilla S&P 500 index fund.
So all that added complexity and higher fees didn't really translate into better returns.
Not according to the evidence Bogle presents.
Like back to the basics.
Keep it simple.
Right.
It raises the question, are we being sold a bill of goods?
Right. Are we being tricked?
Or is there a genuine edge to be gained from these more sophisticated strategies?
Right.
Bogle clearly leans towards the former.
Okay.
But it's something for each investor to consider carefully.
So do your research, basically.
Do your homework.
Yeah, all right. So we can't talk about investing without talking about retirement.
Ah, retirement, the golden year.
Yeah, what does Bogle have to say about, planning for that?
He dedicates a whole chapter to asset allocation and retirement planning, and it's packed with practical wisdom.
Okay.
He starts by emphasizing the importance of aligning your investment strategy with your risk tolerance and time horizon.
Right. So if you're younger, you can take on more risk.
Exactly. A younger investor with a longer time horizon can afford to ride out those market fluctuations.
Right.
While someone closer to retirement might prioritize preserving capital and generating income.
Right. So you're not, losing your nest egg right before you need it.
Exactly. You don't want to be taking on too much risk when you're close to retirement.
Right.
He mentions the classic 60-40 stock bond portfolio as a good starting point for many investors.
Okay, 60-40. That's a good rule of thumb.
But he stresses that there's no one-size-fits-all solution.
Okay.
You need to tailor your approach to your individual circumstances and goals.
So you got to figure out what works for you.
And, of course, he's a big advocate for taking full advantage of tax-advantaged retirement accounts.
Right, like 401ks and IRAs.
Those are essential tools for anyone looking to build a secure retirement.
Can you break down those different types of accounts for our listeners?
Sure. So a 401k is a retirement savings plan offered by many employers.
Right.
You contribute pre-tax dollars,
Uh-huh.
which grow tax-deferred until retirement. And many employers also offer matching contributions.
It's like free money.
It's free money.
Got to take advantage of that.
Absolutely. Then you have IRAs,
Individual retirement accounts.
which stand for individual retirement accounts.
Why?
And there are two main types, traditional IRAs
Okay.
and Roth IRAs.
Traditional and Roth.
With a traditional IRA, your contributions may be tax deductible,
Yeah.
and your earnings grow tax deferred until retirement.
Right.
With a Roth IRA, you contribute after tax dollars,
After tax.
but your qualified withdrawals in retirement are tax-free.
Oh, that's nice.
It's a great option, especially for younger investors who expect to be in a higher tax bracket later in life.
So many choices.
So many options.
Yeah, it's important to kind of, understand the nuances of each one
Absolutely.
to make the most of those, retirement savings tools.
Do your research, talk to a financial advisor.
Right.
And you know what's fascinating? Bogle reminds us not to overlook Social Security in our retirement planning.
Oh, yeah. Good old Social Security.
He encourages us to think of it as a bond-like asset
Okay.
because it provides a guaranteed stream of income backed by the government.
It's like having a pension in a way.
Exactly. So instead of viewing Social Security as a separate thing, we should factor it into our overall asset allocation strategy.
Okay, that makes sense.
And, Bogle shares a personal anecdote in this chapter that really highlights the power of simplicity in retirement planning.
Right.
He created a 60/40 stock bond balance index fund at Vanguard back in 1992.
Got it.
With the idea of offering investors a straightforward, low-cost way to achieve a diversified portfolio without the hassle of constantly adjusting their asset allocation.
So just like set it and forget it.
Yeah, and how has that fund performed?
I'm guessing pretty well.
You're right. Exhibit 19.1 shows that his balanced index fund has consistently outperformed many of its more complex and expensive peers over the past 25 years.
Wow, so simple really does work.
It's a testament to his core belief that simplicity and low costs often trump complexity and high fees when it comes to long-term investing.
That's a powerful message, especially for those who are feeling overwhelmed by all the choices and strategies out there.
It can be a lot to take in,
Yeah.
but sometimes the most straightforward approach is the best.
Keep it simple, stupid.
Yes.
Yeah. All right, so I want to touch on something that Bogle mentions, which is managing expectations.
Expectations, the bane of many an investor.
He's basically saying, we've seen incredible market performance in recent decades.
The past few decades have been pretty extraordinary.
Yeah, but he cautions against expecting those same levels of growth going forward.
Right. The party can't last forever.
So he's not saying like, lower your expectations for financial success, but be realistic.
Be realistic.
Yeah.
In Exhibit 9.2, he shows how the historical average annual return for stocks has been around 9.5%.
Okay. 9.5%. That's pretty good.
It's pretty good, but he points out that several factors, including lower dividend yields, slower earnings growth, and high market valuations, suggest that future returns may be more modest.
Okay, so maybe like 7% or 8%.
Maybe somewhere in that range, but it's hard to say for sure.
Right.
But it's a reality check for those who might be overly optimistic based on past performance.
Right. So don't assume that, the good times are going to keep rolling.
Exactly. We need to be prepared for different market environments and adjust our strategies accordingly.
So this kind of goes against the idea of buy and hold investing, right?
Well, it depends.
Because if returns are going to be lower, shouldn't we be more active in managing our portfolios?
That's a great question, and it brings us to an interesting evolution in Bogle's own thinking.
Okay.
He used to advocate for the your age in bonds rule
Oh, yeah, I've heard of that.
as a general guideline for asset allocation,
Okay.
but he's since come to realize that it's too simplistic.
It's not one size fits all.
Exactly. He now believes in a more nuanced approach
Okay.
that takes into account individual circumstances and goals.
So personalize it, basically.
For example, he suggests that younger investors with a longer time horizon might want to tilt more heavily towards stocks, even if it means accepting more volatility.
Right, you got time to recover.
While older investors closer to retirement might prioritize stability and income over growth.
Right?
It's all about finding the right balance for your specific situation.
So even though, returns might be lower in the future, we shouldn't abandon the principles of buy and hold investing.
Right. We shouldn't get spooked and start trying to time the market.
So just stay the course.
Stay the course and focus on what we can control.
Our savings rate, our costs.
Our asset allocation.
Yeah.
Bogle's message is about staying disciplined, staying the course, and letting time work its magic.
Time is our friend.
Time is our greatest ally.
All right, we'll be back in a moment to wrap up our deep dive into John Bogle's wisdom.
It's interesting how even someone like Bogle, who's seen it all when it comes to investing, can still evolve his thinking.
Yeah, he's not afraid to admit when he's changed his mind.
Yeah, and adapt to, the changing market conditions.
He's always learning, always evolving. Yeah. And one thing that really struck me throughout the book is his critique of the financial industry.
Oh, yeah. He doesn't pull any punches.
He's not afraid to, call out the BS.
He's a straight shooter.
Yeah, and the conflicts of interest.
Right. He sees how Wall Street often prioritizes its own profits over the best interests of its clients.
And he's especially critical of how, financial advisors and brokers often push products that generate high fees for them.
Yeah, even if those products aren't the best fit for the investor.
Right. They're just trying to, line their own pockets.
He calls Wall Street a Falstaffian joke.
A Falstaffian joke.
A giant laundry machine where institutions just shuffle money around, racking up fees without necessarily creating any real value for the individual investor.
So it's like a big casino.
In a way. Yeah.
And we're the ones, placing the bets.
It's a sobering thought.
It's a reminder that we need to be, savvy consumers of financial advice.
Don't just take what you're told at face value.
Right. Do your research.
Ask questions.
Yeah, but, Bogle doesn't just criticize the industry.
No, he offers some practical guidance.
Yeah, for, those who choose to work with a financial advisor.
He stresses the importance of finding an advisor who is truly a fiduciary,
A fiduciary.
meaning they're legally obligated to put your interests ahead of their own.
Right. So they're not just trying to sell you something.
They're acting in your best interest.
And he also recommends looking for advisors who are fee only.
Fee only, meaning they don't receive commissions on the products they sell.
Right. So their advice is unbiased.
Exactly.
And he even provides guidelines for, what you should be paying an advisor.
He says fees above 1% are likely excessive.
Okay, 1%, that's a good benchmark.
He wants investors to be empowered to negotiate fair fees
Right.
and get the best possible value for their money.
So it's like, don't be afraid to shop around.
Exactly.
And Bogle also touches on the rise of robo-advisors.
The robots are coming for our portfolios.
Yeah, these automated platforms that provide investment advice using algorithms.
And he seems cautiously optimistic about their potential.
Okay, so he's not like anti-technology.
No, he recognizes that technology can be a powerful tool.
Right.
He acknowledges that robo-advisors can be a cost-effective alternative to traditional advisors.
Yeah, especially for those who are just starting out.
Right, maybe you don't have a lot of assets to manage.
Yeah.
But he also cautions that investors should still do their homework.
Right.
Understand how these platforms work before entrusting them with their hard-earned savings.
So it's like, don't just blindly trust the robots.
Exactly. Technology is not a substitute for informed decision-making.
So as we wrap up our deep dive into, John Bogle's wisdom, I think it's worth reflecting on the overarching message that he leaves us with.
What's the big takeaway?
Yeah, it's a message of empowerment.
Yeah.
Taking control of our financial destinies and not letting Wall Street dictate our choices.
He wants to put the power back in the hands of the individual investor.
Yeah, he believes that anyone can achieve financial success by adhering to some simple, timeless principles.
Keep it simple, keep costs low, be patient, stay the course.
It's a philosophy that resonates deeply, especially in today's world of constant noise and fleeting trends.
It's a message of hope.
Yeah, and, amidst all the data and analysis, there's a human element to Bogle's message that I find incredibly inspiring.
Yeah, he's not just talking about numbers, he's talking about people.
Yeah, it's about, building a secure future for ourselves and our loved ones.
It's about pursuing our dreams, living our lives to the fullest.
Right.
And not being burdened by financial worries.
Yeah. So as you continue your own investment journey, remember Bogle's words. Enjoy the ride.
Don't let the ups and downs of the market consume you.
Focus on the long term. Make informed decisions.
And savor the fruits of your labor.
That's a perfect note to end on. Thank you for joining us on this deep dive into the Little Book of Common Sense Investing.
It's been a pleasure.
We hope you found it insightful and empowering.
And remember, the greatest investment you can make is in your own knowledge and understanding.
Keep learning, keep questioning, and keep striving to make the best possible choices for your financial well-being.
Until next time, happy investing.
Happy investing.